Before we get started, please remember that I am not a financial advisor, mortgage broker, or loan officer. This presentation is for informational and educational purposes only. The world of finance and real estate is complex and constantly changing. You should always consult with a qualified professional, like a licensed mortgage originator and a real estate agent, to get advice tailored to your specific personal situation. Let's talk about a couple. We'll call them Mark and Jessica. They did everything right. They worked hard, saved up a $20,000 down payment, and for 2 years they obsessively tracked their credit scores. Mark's score hit 742. Jessica's was a solid 755. They were pre-approved online in minutes. They found their dream home, a little 3-bedroom with a big backyard for their golden retriever. They put in an offer, it was accepted, and they were ecstatic. They started packing boxes. Then they got the call from the underwriter. The loan was denied. With a 750 credit score and 20 grand in the bank. How is that even possible? The reason they were rejected is a tiny detail hidden deep in the mortgage rulebook. A detail that trips up thousands of hopeful homebuyers every single year. And by the end of this video, you are going to know exactly what that detail is, and how to make sure it never happens to you. Because the truth is, the question, what credit score do you need to buy a house, is a trick question. It's the wrong question to ask. There is no single magic number. Believing that myth is like trying to open a combination lock when you only know one of the numbers. It's useless. The real question, the one that gets you the keys to your new home, is, what credit score do I need for the right type of loan for my specific financial situation? That's the secret. And today we are unlocking the entire combination. We are going to break down step by step the exact credit score requirements for every major type of home loan in America: conventional, FHA, VA, and USDA. I'm not going to give you vague ranges. I'm going to give you the hard numbers, the minimum set by the government and the real-world scores lenders are actually looking for right now. More importantly, I'm going to show you how a 640 score can sometimes get a better deal than a 740 score, just like what happened to Mark and Jessica. This is the definitive guide you've been searching for. No fluff, no sales pitches. Just the unfiltered truth about credit scores and homeownership. So let's start with the absolute foundation. Why does this 3-digit number have so much power over your life? To a lender, your credit score isn't a judgment of your character. It's a risk calculator. It's a snapshot of your history with debt, boiled down into a single number that predicts one thing: the likelihood that you will pay back your loan on time. A high score says you're a safe bet. A low score flashes a warning sign. When a bank lends you hundreds of thousands of dollars for a house, they aren't just giving you money. They're making a massive 30-year bet on you. Your credit score is how they calculate the odds on that bet. Now you might be checking your score on an app like Credit Karma or through your credit card company. That's a great habit, but there's a critical piece of information you need to know. The score you see is almost certainly a Vantage score. It's a fantastic educational tool. But when you apply for a mortgage, lenders don't use it. They pull a completely different report. They use a specific FICO score model, often an older, more sensitive version, and they don't just pull one. They pull a score from all 3 major credit bureaus: Equifax, Experian, and TransUnion. They take all 3 scores, throw out the highest, throw out the lowest, and use the one in the middle. That's your mortgage credit score. This is why someone can think they have a 720 score, but the lender sees a 695. It's a different scoring model, a different calculation, and a different number. Understanding this from the start saves you from devastating surprises later on. So the lender has your middle FICO score. What's next? They plug it into a framework that's been the backbone of lending for decades. Think of it as the 3 pillars of mortgage approval. Your credit score is just the first pillar. The other 2 are just as important, and this is where Mark and Jessica got into trouble. Pillar number 1 is credit. That's your score, your payment history, how much debt you have, and how long you've been using credit. It's your track record. Pillar number 2 is capacity. This has nothing to do with your credit score. This is about your income and your existing debts. The bank needs to know you have the cash flow, the capacity to handle a new massive mortgage payment every month. They measure this with something called the debt-to-income ratio, or DTI. They add up all your monthly debt payments, car loan, student loans, credit card minimums, and they add your potential new mortgage payment. Then they divide that total by your gross monthly income. If that percentage is too high, it doesn't matter if you have an 800 credit score. They see you as overextended, and it's a red flag. Pillar number 3 is collateral. The collateral is the house itself. The bank hires an appraiser to make sure the house is actually worth the amount of money they're lending you. If you agree to pay $400,000 for a house but it only appraises for $350,000, you have a problem. The bank will only lend you money based on the appraised value, not the price you agreed to pay. You need all three pillars to be strong. Mark and Jessica had great credit, pillar 1, and the house appraised just fine, pillar 3. Their problem was pillar 2, capacity. Mark had recently co-signed a car loan for his younger brother. He wasn't making the payments his brother was, but because his name was on the loan, the full payment counted against his DTI, pushing them just over the lender's limit. A tiny, forgotten detail that cost them their dream home. They had the score but not the full picture. This is why focusing only on the score is a trap. You have to see the whole board. Now, with that crucial foundation laid, let's get to the numbers you came here for. We're going to start with the loan that has opened the door to homeownership for more Americans than any other. The FHA loan. FHA stands for the Federal Housing Administration. It's not a lender. It's a government agency that insures the loan for the bank. By insuring the loan, the FHA reduces the bank's risk. If you default, the FHA helps cover the bank's loss. Because of this government insurance, lenders are willing to approve borrowers with lower credit scores and smaller down payments. This makes FHA loans the #1 choice for many first-time homebuyers and people who have had some credit challenges in the past. So what's the magic number for an FHA loan? The FHA itself sets the absolute rock-bottom minimum credit score at 500. Yes, you heard that right. 500. In theory, you can get an FHA loan with a 500 credit score. But, and this is a massive but, there's a catch. To qualify with a score between 500 and 579, you are required to put down at least 10% of the home's purchase price. So on a $300,000 house, that's a $30,000 down payment. For most people in that credit score range, coming up with that much cash is a huge obstacle. This is why the more important number, the one that truly unlocks the main benefit of an FHA loan, is 580. Once your credit score hits 580, the minimum down payment requirement plummets from 10% all the way down to just 3.5%. On that same $300,000 house, your down payment drops from $30,000 to just $10,500. That is a game-changing difference. That 8-point jump from 579 to 580 saves you nearly $20,000 in cash you need at closing. It is arguably the single most impactful credit score threshold in the entire mortgage industry. Now hold on. Just because the FHA allows a 580 score doesn't mean every bank will approve you. This is one of the most misunderstood parts of the process. Individual lenders are allowed to have their own, stricter guidelines on top of the FHA's rules. These are called lender overlays. So while the FHA says 580 is okay, a big bank might have an overlay that says, "We don't lend to anyone with a score below 620, no exceptions." Another lender might say 600. This is why it is absolutely critical to shop around. If one lender denies you, it doesn't mean you can't get a loan. It might just mean you haven't found the right lender whose overlays match your profile. You could be a perfect fit for the bank down the street. Don't give up after the first no. FHA loans are fantastic, but they do have a downside you need to be aware of. Mortgage insurance premium, or MIP. Because you're considered a higher-risk borrower, you have to pay for that government insurance policy. This comes in two parts. First, an upfront premium that's usually rolled into your total loan amount. Second, and more importantly, a monthly premium that's added to your mortgage payment every single month. And here's the key difference. On most FHA loans today, that monthly mortgage insurance lasts for the entire life of the loan, for all 30 years. The only way to get rid of it is to refinance into a different type of loan, like a conventional loan, once you have enough equity and a higher credit score. It's the price you pay for the lower barrier to entry. So while that FHA loan is an incredible tool, a fantastic doorway into homeownership, that permanent mortgage insurance is the catch. It's the trade-off. But what if there was another way? What if there was a loan designed for people who have been a bit more disciplined with their credit, a loan that rewards you for your financial responsibility? There is. And for most people, this is the goal. This is the loan type you graduate to. It's called a conventional loan. This is the big leagues. Conventional loans are not backed by a government agency like the FHA. Instead, they are bought and sold by two giant government-sponsored enterprises you've probably heard of, Fannie Mae and Freddie Mac. Because there's no government guarantee protecting the lender if you default, the requirements are stricter. They're taking on more risk, so they need to see that you are a less risky borrower. And how do they measure that risk? You guessed it, your credit score. So what's the magic number? What is the absolute minimum credit score you need to even get your foot in the door for a conventional loan? The number you need to burn into your memory is 620. 620. That is the floor. If your score is 619, the automated underwriting systems that lenders use will, in almost all cases, automatically deny you. It's a hard and fast line in the sand, but hitting 620 is like finding the key to a brand new car. It doesn't mean you can win the Indy 500, but it does mean you can start the engine. It opens up a whole new world of possibilities that are simply not available with lower scores. Now you might be thinking, okay, 620, I can get there. But I've always heard you need to put 20% down for a conventional loan. I don't have $50, $60, or $100,000 in cash lying around. This is one of the biggest, most persistent, and most damaging myths in all of real estate. Let me be crystal clear. You do not need a 20% down payment for a conventional loan. This is where the game changes. For first-time homebuyers, you can get a conventional loan with as little as 3% down. 3%. That's even less than the FHA's 3.5% requirement. If you've owned a home before, the minimum is typically 5% down. The 20% down payment myth is so powerful because putting 20% down does do something very important. It allows you to avoid mortgage insurance altogether. But if you put down less than 20%, you will have mortgage insurance. On a conventional loan, it's not called MIP, it's called PMI, which stands for private mortgage insurance. And on the surface, it looks the same. It's an extra fee tacked onto your monthly mortgage payment that protects the lender, not you. But there is one colossal, game-changing difference between FHA's MIP and conventional's PMI. Conventional PMI is not permanent. It's designed to go away. By law, once your loan balance drops to 78% of the original purchase price of your home, the lender is legally required to automatically terminate your PMI. You don't have to call, you don't have to fill out a form, you don't have to beg. Just stops. That extra $100, $200, or $300 a month vanishes from your payment, and your mortgage suddenly becomes that much more affordable. And it gets even better. You can often request to have it removed even earlier, around the 80% mark, especially if your home's value has increased. This is the single biggest financial advantage of a conventional loan over an FHA loan. It has a built-in escape hatch from mortgage insurance, saving you tens of thousands of dollars over the life of the loan. But to get this amazing benefit, you need that 620 score. And this is where we need to have a serious talk. Just because 620 is the minimum score doesn't mean it's the score you should aim for. Getting a conventional loan with a 620 credit score is like trying to run a marathon with a sprained ankle. You might be able to finish, but it's going to be painful and it's going to cost you. Let me show you what I mean. Let's invent two homebuyers, Alex and Ben. They're buying identical houses in the same neighborhood for $400,000. They both have the same income and are both putting 5% down. The only difference is their credit score. Alex has a 640 credit score. He's just over the minimum, but he's in the game. Ben, on the other hand, has spent the last year working on his credit. He's paid down his credit cards, disputed an error on his report, and has a 740 credit score. They both go to the same lender on the same day. Alex, with his 640 score, is seen as a higher risk. The lender offers him an interest rate of, let's say, 7.5%. Because his score is on the lower end, his private mortgage insurance is also more expensive. It's calculated as a percentage of the loan amount, and for him, it might be around 1% per year. Ben, with his 740 score, is a lender's dream. He's proven he's responsible with debt. The lender offers him a much better interest rate, maybe 6.5%. And his PMI? It's significantly cheaper, maybe only 0.4% per year. Now, you might be thinking, okay, 1% difference in the interest rate, a little bit on the PMI, how much can that really matter? Let's do the math. For Alex, with his 7.5% interest rate, his principal and interest payment on a $380,000 loan is about $2,657 per month. His PMI at 1% adds another $317 per month. So Alex's total monthly payment is $2,974. Now let's look at Ben. With his 6.5% interest rate, his principal and interest payment is $2,402 per month. His cheaper PMI at 0.4% only adds $127 per month. Ben's total monthly payment is $2,529. That is a difference of $445 every single month. $445. That's a car payment. That's your entire grocery bill for a week or two. That's a flight to see your family. Every single month. Over the course of a year, Ben is paying $5,340 less than Alex for the exact same house. But it gets so much worse. Let's look at the total interest paid over 30 years. Alex, with his higher rate, will pay approximately $576,000 in total interest. Ben, he'll pay about $484,000 in total interest. That 100-point difference in their credit score will cost Alex over $92,000. $92,000. Enough to buy a luxury car, fund a child's college education, or completely transform his retirement. It's an astronomical sum of money, all because of a 3-digit number. You see, lenders don't just see one big group of 620 and up. They see tiers. They have buckets. 620 to 639 is one bucket. 640 to 659 is another. 660 to 679 and so on, usually in 20-point increments. Each time you climb into a higher bucket, the rates get better, the PMI gets cheaper, and the entire proposition of homeownership becomes more favorable for you. The difference between a 679 score and a 680 score can be the difference between a good rate and a great rate, potentially saving you thousands of dollars. That one extra point pushes you into the next tier. This is why your credit score isn't just a number. It's a measure of your financial power. It's the key that not only unlocks the door to the conventional loan, but also determines how much you're going to pay for the privilege of walking through it. A 620 gets you in, but a 720, 740, or 760 gets you the VIP treatment. You pay less for the exact same product. So, the conventional loan is the workhorse of the mortgage industry, the one most people strive for. It offers flexibility, incredible long-term savings, and the ability to shed that dreaded mortgage insurance. And it all starts with that 620 credit score. But what if you're in a unique situation? What if you've served in the military? Or what if you're looking to buy a home way out in a rural area, far from the city? The rules change again. There are 2 other major government-backed loans that have some of the most shocking and incredible benefits you can imagine. And for one of them, the minimum credit score is, believe it or not, even lower than an FHA loan. And for the other, the down payment requirement is 0. Absolutely nothing. We're going to break those down next. Let's start with the loan that requires 0 down payment. This is the VA loan, and it is, without a doubt, one of the most powerful mortgage products on the planet. But it's not for everyone. This is a special benefit earned through service to our country. VA loans are available to active duty service members, veterans, and in some cases, surviving spouses. If you think you might be eligible, you need to look into this because the benefits are just that good. Now let's talk about that credit score. I'm going to tell you something that most lenders won't say up front. The U.S. Department of Veterans Affairs, the VA and VA loan, does not, I repeat, does not set a minimum credit score requirement. There is no magic number written down in their official guidelines. So, if the VA itself doesn't have a minimum, why does every bank you talk to tell you that you need a 620 or a 640 score to get a VA loan? The answer is a single word that you need to understand: overlays. A lender overlay is an extra rule, an extra requirement, that a bank or mortgage company adds on top of the VA's own guidelines. Think of it like this. The VA sets the base rules for the game, but the lender you're playing with adds a few of its own house rules to protect itself. Lenders are in the business of managing risk. Even though the VA guarantees a portion of the loan if you default, which is what makes this whole program possible, the lender still takes a financial hit. It's a messy, expensive process for them. So to reduce their risk, they create an overlay, a private minimum credit score requirement. So what score do you actually need? In the real world, most lenders will set their overlay for a VA loan somewhere between a 580 and a 640 credit score. The most common number you'll hear is 620. If your score is above 620, you'll find that a lot of doors are open to you. If it's between 580 and 620, you'll have to shop around a little more, but there are absolutely lenders who will work with you. But here's the most incredible part. Because the VA has no official minimum, it is technically possible to get a VA loan with a credit score below 580. It's rare, and it requires a process called manual underwriting, where a human being, not a computer algorithm, scrutinizes every single detail of your financial life. You'd need what are called compensating factors, things like a large amount of cash in savings, a very low amount of other debt, or a long stable history at your job. It's a high bar to clear, but it's possible. Some lenders will even consider applicants with no credit score at all, using alternative data like rent and utility payment history. This flexibility is almost unheard of in the mortgage world. And the benefits don't stop there. The zero down payment feature is the headliner, but the supporting cast is just as impressive. With a VA loan, you do not have to pay private mortgage insurance or PMI. On a conventional loan, if you put down less than 20%, you get hit with PMI, which is an extra monthly fee that protects the lender, not you. It can easily add hundreds of dollars to your monthly payment. VA loans completely eliminate this. Instead, most borrowers will pay a one-time VA funding fee. This fee goes directly to the VA to help keep the program running for future generations. The exact percentage varies based on your service, your down payment amount, and whether it's your first time using the benefit. But here's the key. It can be rolled into your total loan amount, so you don't have to pay it out of pocket at closing. And importantly, veterans receiving VA disability compensation are typically exempt from this fee entirely. Add in the fact that VA loans often have some of the most competitive interest rates on the market, and you can see why it's such an incredible benefit. So we've covered the zero down payment powerhouse for our service members and veterans. But what about that other loan I mentioned? The one that can help you buy a home in a surprising number of places with a low credit score and, get this, also requires zero down payment. This is the USDA loan. No, it has nothing to do with the steak you buy at the grocery store. It stands for the United States Department of Agriculture, and their loan program is one of the best-kept secrets in real estate. The goal of the USDA loan program is to promote homeownership in less dense parts of the country. And when you hear that, you're probably picturing a farmhouse in the middle of a cornfield. And while that would certainly qualify, the definition of rural for the USDA is incredibly broad. It includes huge swaths of suburban America, small towns, communities on the outskirts of major metropolitan areas. You would be absolutely shocked at the number of properties that are eligible for a zero down payment USDA loan. There is a map on the USDA's website where you can type in an address, and it will tell you instantly if it's in an eligible area. For many people, seeing that map for the first time is a complete game changer. Okay, so what about the credit score? The USDA program has a fascinating two-track system. The magic number here is 640. If your credit score is 640 or higher, your application can go through the USDA's automated system, called the Guaranteed Underwriting System, or GUS. As long as you meet the income limits and other requirements, it's a relatively streamlined, straightforward path to approval. But what if your score is below 640? This is where it gets interesting. If your score is, say, 639 all the way down to about 580, your application gets kicked out of the automated system and goes to manual underwriting. Just like with the VA loan, this means a loan officer is going to personally review your entire file. They're looking for a story. They're looking for reasons to say yes, even though the computer said maybe not. And this is where you can win. They will look for those same compensating factors we talked about before. Do you have a history of saving money? Have you been at the same job for 3 years? Is your rent payment for the last 12 months higher than your proposed new mortgage payment? Can you show a solid history of paying all your other bills on time, even if your score took a hit from something in the past? Each yes to these questions builds your case. Now, to be clear, just like with FHA loans, getting approved with a score below 580 is extremely difficult. Most lenders will have an overlay that prevents them from going that low. But the official USDA guideline doesn't have a hard floor. The flexibility is built into the system for those scores in the low 600s, giving you a fighting chance that you might not have with other loan types. And just like the VA loan, the USDA loan offers 100% financing. That means zero down payment required. This is huge for first-time homebuyers who have a steady income to afford the monthly payments, but haven't been able to save up the massive pile of cash needed for a traditional down payment. Instead of PMI, USDA loans have a similar feature called a guarantee fee, which includes a small upfront portion that can be rolled into the loan and a small annual fee paid monthly. It serves the same purpose, protecting the lender, but it's often cheaper than the mortgage insurance on an FHA loan. So between the FHA, VA, and USDA, we have these incredible government-backed programs designed to make homeownership possible for people who might not fit into the perfect little box that traditional banks prefer. They allow for lower credit scores, smaller down payments, and in 2 cases, no down payment at all. They are the entry point for millions of American families. But what if you don't qualify for a VA or USDA loan? What if you have a decent credit score and have managed to save up a small down payment? Then you enter the world of conventional loans. This is the biggest part of the mortgage market, and the rules are a little different. The credit score requirements are higher, the standards are stricter, and the entire game changes. And that's exactly what we need to break down next. So let's talk about the world of conventional loans. If FHA, VA, and USDA loans are like specialized tools in a toolbox, the conventional loan is the powerful all-purpose hammer that builds most of the houses in America. This is the private market. There's no direct government insurance policy cushioning the fall if you default. It's just you, the lender, and a set of rules dictated by 2 of the most powerful, yet least understood, players in the entire housing market: Fannie Mae and Freddie Mac. Now, you've probably heard those names, but most people think they're government agencies. They're not. They are government-sponsored enterprises, which is a fancy way of saying they're private companies with a public mission, created by Congress to keep the housing market flowing with cash. Here's how it works, and this is the secret key to understanding everything about conventional loans. You go to your local bank or credit union to get a mortgage. They approve you and give you the money. But that bank doesn't want to just sit on your 30-year loan for the next 3 decades. They need to get that money back so they can lend it out to the next person who walks in the door. So what do? They bundle up your mortgage with a bunch of others and sell it to Fannie Mae or Freddie Mac. This is the secondary market. Fannie and Freddie buy the loan, the bank gets its cash back, and the cycle continues. It's the engine that powers the entire American mortgage system. But here's the critical part. Because Fannie and Freddie are the biggest buyers, they get to set the rules. They say to the banks, "We will only buy loans that meet our specific criteria. The borrower must have this kind of income, this much debt, and, most importantly, this minimum credit score." Any loan that meets these rules is called a conforming loan. And if a loan doesn't conform, the bank is stuck with it, which they don't want. So, in practice, the rules set by Fannie and Freddie become the rules for almost every conventional lender in the country. So, what is their magic number? What is the absolute rock-bottom minimum credit score that Fannie Mae and Freddie Mac will even consider for a conventional loan? That number is 620. And I need you to hear me very clearly on this. A 620 credit score for a conventional loan is like the minimum height requirement for a roller coaster. Yes, technically it gets you through the gate, but it guarantees you are in for a very, very rough ride. Getting a conventional loan with a 620 is technically possible in the same way that landing a 747 in a hurricane is technically possible. It requires perfect conditions, a lot of luck, and most of the time it just doesn't happen. The reason why comes down to 2 of the most important acronyms in the mortgage world: LLPA and PMI. Let's start with LLPAs, or loan level price adjustments. This is the hidden pricing matrix of the mortgage industry. Think of it as a risk chart. Fannie and Freddie say, okay, a 620 score is our minimum, but a borrower with a 620 is way riskier than a borrower with a 780. So if a lender wants to sell us a loan for a 620 score borrower, they have to pay us an extra fee to compensate for that risk. That fee, the LLPA, isn't paid by the lender out of their own pocket. Oh no, they pass that cost directly on to you, the borrower, in the form of a higher interest rate. Let me paint a picture. Imagine a giant grid. Along the top are credit scores in brackets: 620 to 639, 640 to 659, and so on all the way up to 780 and above. Down the side is your down payment, or more specifically, your loan-to-value ratio. The lower your credit score and the smaller your down payment, the bigger the penalty you pay. A 630 score with only 5% down is in the highest risk box on that grid. It might come with a pricing adjustment of 2 or 3%. That doesn't mean your rate is 3% higher, but it means the lender has to pay a fee of 3% of the loan amount, a cost they bake into the interest rate they offer you for the entire life of the loan. Conversely, someone with a 780 score and 25% down, they're in the golden box. Their LLPA is 0. They get the absolute best, cleanest interest rate possible. This is why you can see an advertised rate online, but the rate you're actually quoted is half a point or even a full percentage point higher. It's not a bait and switch. It's the LLPA matrix at work, penalizing your specific risk profile. So let's break down what these scores really mean in the conventional world. Think of 620 to 679 as the expensive zone. if you manage to get approved here, and that's a big if, you are paying the maximum price for that loan. Your interest rate will be significantly higher because of those LLPAs. You will also need what lenders call compensating factors. This means you better have a large down payment, a very low debt-to-income ratio, and a ton of cash in the bank after closing. You are seen as a high risk, and you have to prove in every other way that you are not. The real game starts at a 680. Think of 680 to 739 as the competitive zone. A 680 score is a major milestone. The LLPA penalties start to decrease significantly. Lenders take you more seriously. You have more options. You're no longer on the defensive trying to justify your application. You're a solid candidate. A 700 is even better. A 720 puts you in a very strong position. In this range, you're getting good, competitive interest rates. You are on the right side of the fence. But the promised land, the place you want to be, is the 740 plus elite zone. Once your credit score hits 740, the entire dynamic shifts. The LLPA penalties become minimal or disappear entirely. At 760, they're gone. You are now a premium top-tier borrower. You are not asking the bank for a loan. They are competing for your business. You will be offered the best published rates, the lowest fees, and the smoothest process. Every point above 740 is just solidifying your position as a lender's dream client. But the interest rate isn't the only thing your credit score attacks. Remember that other acronym? PMI, or private mortgage insurance. With a conventional loan, if you put down less than 20%, the lender sees that as a risk. To protect themselves, they require you to buy an insurance policy. But here's the catch. You pay the monthly premium, but the policy only protects the lender if you foreclose. You get no benefit from it whatsoever. And the cost of that monthly PMI premium is based almost entirely on, you guessed it, your credit score and your down payment. Someone approved with a 640 score and 3% down might pay a PMI rate of over 1% of the loan amount per year. On a $400,000 loan, that's $4,000 a year, or an extra $333 tacked onto your mortgage payment every single month. That's a car payment. Meanwhile, the borrower with a 760 score and the same 3% down payment might have a PMI rate of just 0.4%. That's only $133 a month. That's a $200 a month difference purely because of their credit score. Over 5 years, that's $12,000 in extra money you've paid for nothing. So when you combine the higher interest rate from the LLPAs with the higher monthly cost of PMI, a low credit score on a conventional loan is a devastating 1-2 punch to your wallet. It can literally be the difference between a home being affordable and being completely out of reach. This is why, for a conventional loan, the answer to what score do you need is so much more complex. The technical floor is 620, but the realistic functional minimum to avoid truly punitive rates is closer to 680. And the optimal target, the number that unlocks the best possible terms and saves you the most money, is 740. So we've covered the big 3 government loans and the king of them all, conventional loans. But what if your score is below these minimums? What if you're sitting at a 580, a 550, or even lower? Is the dream of homeownership completely dead? Not necessarily. There are specialized paths and powerful strategies, but they come with their own set of warnings. And that's where we're going next. Into the world of what to do when your credit score isn't just low. It's in the danger zone. So you're in the danger zone. Your credit score is sitting in the 500s, maybe the low 600s, and every article you read, every bank you talk to, makes it feel like the door to homeownership is bolted shut with a giant "do not enter" sign hanging on it. The dream feels like it's slipping through your fingers. But what if I told you that the US government created a set of master keys designed specifically for this door? These aren't perfect keys. They come with their own unique set of teeth, their own costs, and their own rules. But for millions of Americans, they are the only keys that work. Let's start with the most famous one, the workhorse of the low-credit mortgage world, the FHA loan. FHA stands for the Federal Housing Administration, and their entire mission since the 1930s has been to make housing more accessible. They don't actually lend you the money. Instead, they insure the loan for the bank. Think of it like this. You're asking the bank to bet on you, but your track record, your credit score, makes them nervous. The FHA steps in and tells the bank, "Hey, don't worry. If this person can't pay, we've got your back. We'll cover your losses." This insurance is the secret sauce that makes lenders willing to say yes to borrowers they would otherwise turn away. Now for the number you've been waiting for. The absolute rock-bottom bare minimum credit score the FHA will even look at is 500. But I need you to hear me loud and clear on this. Getting an FHA loan with a credit score between 500 and 579 is like trying to climb a sheer cliff face during a hurricane. It is technically possible, but it is incredibly difficult. First, you'll be required to come up with a 10% down payment. That's a massive hurdle. On a $300,000 home, that's $30,000 in cash. Second, you will struggle to find a lender willing to approve you. Even with the FHA's insurance, a sub-580 score is a huge red flag for most banks. They'll scrutinize every single line of your financial life, looking for any reason to say no. It's not impossible, but it is an uphill battle in every sense of the word. The real magic of the FHA program kicks in when your score hits 580. That number is the golden ticket. Once you cross the 580 threshold, the entire game changes. Suddenly, that 10% down payment requirement plummets to just 3.5%. On that same $300,000 home, you now only need $10,500 down instead of $30,000. This is, without a doubt, the single biggest reason FHA loans are so popular. It opens the door for people who are responsible with their monthly budget, but haven't been able to save up a massive 20% down payment. It's a powerful, life-changing tool. But this is where the story takes a turn. The government's insurance isn't free. You, the borrower, have to pay for it. And this is the part that so many people don't fully understand until it's too late. It's called mortgage insurance premium, or MIP, and it comes in two parts. First, there's the upfront mortgage insurance premium. This is a one-time fee, currently 1.75% of your total loan amount. So, on a $300,000 loan, that's an extra $5,250 you have to pay. Most people don't pay this out of pocket. They roll it into their total loan balance, which means you're paying interest on it for the next 30 years. But the upfront fee is just the appetizer. The main course, and the part that can become a financial anchor around your neck, is the annual mortgage insurance premium. Despite its name, you pay it in monthly installments. This is an extra fee tacked onto your mortgage payment every single month. The exact amount depends on your loan size and down payment, but it's often a couple of $100s. On that $300,000 loan, you could be looking at an extra $200 a month, or $2,400 a year, that goes to absolutely nothing. It doesn't pay down your principal, it doesn't build you equity. It's purely the cost of the insurance that allowed you to get the loan in the first place. And here is the most critical, most expensive catch of all. If you get an FHA loan with a down payment of less than 10%, which is what almost everyone does, you will pay that monthly mortgage insurance premium for the entire life of the loan. Let me repeat that. For all 30 years. It never goes away. If you pay an extra $200 a month for 30 years, you will hand over an extra $72,000. That's a brand new luxury car. It's a college fund. It's a significant chunk of your retirement. It is the hidden price tag of buying a home with a low credit score. Unlike a conventional loan, where the private mortgage insurance, PMI, automatically drops off once you have 22% equity, FHA MIP sticks to you like glue. The only way to get rid of it is to refinance into a conventional loan later on, once your credit and equity have improved. Now, the FHA isn't the only master key. There are two other incredibly powerful government-backed programs, but they are for very specific groups of people. First, we have the VA loan, and if you are eligible for it, it is arguably the best mortgage product on the planet. This is for veterans, active duty service members, and some surviving spouses. The Department of Veterans Affairs guarantees a portion of the loan, similar to the FHA. And here's the headline. The VA itself does not set a minimum credit score. But, just like with FHA, individual lenders do. Most lenders will want to see a score of at least 620 to approve a VA loan. The benefits are simply staggering. Zero down payment required. That's right, you can buy a home with absolutely no money down. And even better, there is no monthly mortgage insurance. None. That $72,000 FHA trap we just talked about? It doesn't exist with a VA loan. There is a one-time VA funding fee, which varies, but many veterans are exempt, and for those who aren't, it can be rolled into the loan. If you have any connection to the military, you owe it to yourself to see if you qualify. The third key is the USDA loan. This is from the U.S. Department of Agriculture, and no, you don't have to be a farmer to get one. These loans are designed to help develop rural and suburban areas. Their definition of rural is surprisingly broad. You'd be shocked at how many towns just outside major city centers qualify. The goal is to help low to moderate income families. Similar to the VA, the USDA doesn't have a hard credit score minimum. But lenders who issue these loans typically look for a score of 640 or higher. The main benefit? Just like the VA loan, you can get a USDA loan with zero down payment. It's another path to homeownership with very little cash up front. There are income limits, and the property has to be in an eligible area. But it's a phenomenal option if you meet the criteria. It does have mortgage insurance, but it's typically cheaper than the FHAs. So you have these three paths: FHA, the workhorse for almost anyone with a 580 score but with the massive long-term cost of MIP. VA, the superstar loan for military members with no down payment and no monthly mortgage insurance. And USDA, the specialist for buyers with modest incomes in designated areas, also with no down payment. These are the lifelines. They are the established, government-approved ways to get into a home when your credit score has locked you out of the conventional market. But choosing one of these paths feels like a trap in itself, doesn't it? Especially with FHA, you're essentially forced to accept a deal where you pay tens of thousands of extra dollars over the long haul, all because of a 3-digit number. It's a solution, but it's an expensive one. It makes you wonder, is this the only way? Are you simply stuck choosing the best of the bad options? Or is there a way to play the game differently? What if you could fix the root of the problem, the score itself, faster than you think? What if there were strategies to break free from the world of government-insured loans and their costly strings, and step into the prime world of conventional lending, even if that seems impossible right now? That's the real question we need to answer. And to answer that, we have to leave the world of government guarantees behind and step into the arena where the vast majority of home loans in America are born. This is the world of conventional mortgages. If an FHA loan is like getting a driver's permit with a required cosigner, in that case, the government, a conventional loan, is getting your full, unrestricted license. You're seen as ready to handle the road on your own. But this freedom comes with a much higher bar for entry. So what exactly is a conventional loan? Simply put, it's a mortgage that is not insured or guaranteed by the federal government. There's no FHA, no VA, no USDA backing it up. It's a transaction purely between you and the lender. Now, you might think this means every single bank and credit union just makes up its own rules from scratch. A complete Wild West. But that's not how it works. In reality, the entire conventional loan market in the United States is dominated by two invisible giants, two entities whose names you might have heard, but whose power you might not fully grasp: Fannie Mae and Freddie Mac. These are not direct lenders. You can't walk into a Fannie Mae branch and apply for a loan. Instead, think of them as the massive, multi-trillion-dollar wholesalers of the mortgage industry. Your local lender, the bank on the corner, is the retail store. When they give you a mortgage, they don't want to hold on to that loan for 30 years tying up their cash. They want to sell it almost immediately to free up their money to make more loans. And who do they sell it to? Most of the time, it's Fannie Mae or Freddie Mac. Because Fannie and Freddie buy up the majority of American mortgages, the rules they set for the loans they are willing to purchase become the de facto rules for the entire industry. If a lender wants to be able to sell your loan has to fit inside the box that Fannie and Freddie have created. This is why a bank in Miami, a credit union in Seattle, and an online lender in Chicago will all have remarkably similar baseline requirements. They're all building their product to fit the specifications of the same buyer. And this brings us to the number you've been waiting for: the absolute rock-bottom baseline minimum credit score that Fannie Mae and Freddie Mac will even consider for a conventional home loan. That number is 620. Let me say it again because it's critical. The minimum credit score is 620. This is the "you must be this tall to ride" sign at the entrance to the conventional loan roller coaster. If your score is 619, the gate is closed. The system will automatically reject the application. Period. But here is the most important warning I can give you. And it's a mistake that costs people thousands of dollars and immense frustration. Getting a loan with a 620 credit score is not the same as getting a good loan. It's not even the same as getting approved at all. That 620 is just the minimum requirement set by the wholesalers, by Fannie and Freddie. The retail store, your lender, gets to have its own say. This is a concept called lender overlays. An overlay is an additional, stricter requirement that a specific lender adds on top of the baseline minimums. Think of it this way. Fannie Mae says the student needs a D- to pass the course. But the teacher, your lender, says, "In my classroom, to get a passing grade and my recommendation, you need at least a C+." The teacher isn't breaking the rules. They're just adding their own, higher standard to protect their own reputation and reduce their risk. Lenders do this because they are on the front lines. If a loan goes bad early on, the lender can be forced to buy it back from Fannie or Freddie, taking a massive loss. So, to protect themselves, many lenders create overlays. One bank might say, "We won't accept any score below 640. Another, more conservative lender might set their minimum at 660 or even 680. This is why you can get denied for a conventional loan at one bank and then walk across the street and get approved at another. It wasn't you that changed. It was the lender's internal risk tolerance, their overlays. So while 620 gets you in the game, you'll find far more lenders willing to play ball once you cross the 640 and 660 thresholds. But even then, even when you get approved, you are not getting the same deal as someone with a higher score. Not even close. And this is where the real cost of a good enough credit score is hidden. It's hidden in something called loan level price adjustments, or LLPAs. That sounds complex, but the idea is simple. Fannie and Freddie have a giant complicated chart. On one side is your credit score. On the other side is your down payment amount, or what's called loan to value. The chart then spits out an adjustment, which is essentially a fee based on how risky the loan is perceived to be. A lower credit score and a smaller down payment mean higher risk, and therefore a larger fee. This fee is then passed on to you by the lender, not as an upfront charge, but baked into your interest rate. Let's make this real. Imagine two people, Sarah and Ben. Both are buying identical $400,000 homes, and both have a 10% down payment, meaning they're both financing $360,000. They are identical in every way, except for one thing: their credit score. Ben has worked hard to get his score up. He's finally hit 640. He gets approved for a conventional loan and he's thrilled. He's avoided FHA mortgage insurance for life. But because of his 640 score and 10% down payment, the LLPA chart flags him as a higher risk. The lender looks at the adjustment and offers him an interest rate of, let's say, 7.25%. Now let's look at Sarah. Sarah has been diligent for years. She has a 760 credit score. When the lender runs her profile through the same LLPA chart, she is seen as the lowest possible risk. Her adjustment is 0. The lender offers her the best possible rate they have, which on the same day is 6.25%. A single percentage point. It doesn't sound like that much, does it? But let's do the math. Ben's monthly principal and interest payment at 7.25% on his $360,000 loan is $2,455. Sarah's monthly payment at 6.25% is $2,216. That's a difference of $239 every single month. That's nearly $2,900 a year every year for 30 years. But it gets so much worse. Over the full 30-year term of the loan, Ben, with his good enough 640 score, will pay a staggering $523,000 in total interest. Sarah, with her excellent 760 score, will pay about $438,000 in total interest. By having a higher credit score on the exact same loan, Sarah will save $85,000. Let that sink in. $85,000. That's a college education, a fleet of new cars, the seed money for a business. It is a life-changing amount of money, and the only difference was a number in a computer system. This is the real answer to our question. The score you need to get a conventional loan is 620, but the score you need to avoid paying a massive hidden financial penalty is much, much higher. So what is that magic number? What is the goalpost you should actually be aiming for? In the mortgage world, the top tier, the A+, the gold standard credit, typically starts at a score of 740. Sometimes you'll see a small benefit up to 760 or even 780, but 740 is the major threshold. Once you cross 740, you have effectively minimized or completely eliminated those loan level price adjustments. You are being offered the best interest rates and the best terms that the entire market has to offer. You've moved from the bleachers to the front row. The system is no longer working against you. It's working for you. So the 620 score gets your foot in the door, but the 740 score gets you the keys to the kingdom. But what if you're stuck at 650? What if a late payment from 3 years ago is still haunting you? How do you actually bridge that gap from paying a penalty to earning a discount? It's not about magic. It's about a very specific and often misunderstood set of rules that govern how your score is calculated. And understanding those rules is the difference between paying an extra $100,000 for your home or not. So what are these rules? What is this secret formula? It's not hidden in a vault somewhere. It's actually public knowledge, but it's presented in a way that's so boring, so full of jargon, that most people never bother to learn it. But we're going to break it down right now because this isn't just numbers on a screen. This is the blueprint to your financial freedom. The entire system, the FICO score that 90% of lenders use, is built on 5 pillars. 5 simple categories. And your final score is just a weighted average of how you perform in each one. The first and most important pillar, the undisputed heavyweight champion of your credit score, is your payment history. This makes up a whopping 35% of your entire score. Think of it like this. Your credit is your financial trustworthiness resume, and payment history is the references section. It answers the most fundamental question a lender has. If I give you my money, will you give it back on time? Every single late payment is a negative mark on that resume. A payment that's 30 days late is bad. 60 days late is worse. And a 90-day late payment, a charge-off, or a collection account can be a nuclear bomb to your score, with effects that linger for 7 long years. It doesn't matter if it was a $10 medical copay you forgot about or a $10,000 car payment. To the algorithm, late is late. This is why the single most powerful thing you can do to protect your score is to set up automatic payments for at least the minimum amount due on every single one of your accounts. No exceptions. It's the ultimate safety net against a simple mistake costing you thousands in mortgage interest. The second most important pillar, and the one that trips up almost everyone, is called amounts owed. But what it really means is credit utilization. This is 30% of your score. Now this is where things get interesting. Imagine your total credit limit across all your credit cards is a big empty room. Let's say you have a total limit of $20,000. That's a 20,000 square foot room. Now imagine your current balance is $10,000. You filled half the room with stuff. It's starting to look a little crowded, a little risky. Now imagine your balance is $19,000. The room is packed to the ceiling. It looks chaotic, unstable, like you're living right on the edge. Lenders see that high utilization and they get nervous. They think you're overextended and one small emergency away from defaulting. Conversely, if your balance is only $1,000, that big room is 95% empty. It looks clean, managed, and responsible. You have plenty of breathing room. This is what lenders want to see. The general rule of thumb you hear everywhere is to keep your utilization below 30%. And that's okay advice. But if you want a top-tier score, the kind that gets you the absolute best mortgage rates, the secret is to keep it under 10%. And here's the killer mistake people make. They think, I pay my bill in full every month, so my utilization is 0, right? Wrong. Most credit card companies report your balance to the credit bureaus on your statement closing date, not your payment due date. So you could charge $5,000, get your statement, pay it all off by the due date, but the credit bureaus still see that $5,000 balance for that month. The pro move? Find out your statement closing date for each card and pay down the balance before that date. This is one of the fastest ways to manipulate your score upward, legally and ethically, in a short period of time. Next up, accounting for 15% of your score, is the length of your credit history. This is the work experience section of your resume. It looks at the average age of all your accounts and the age of your oldest account. A long, stable credit history is like a decades-long career with steady promotions. It shows you're not new to this. You've managed debt through good times and bad. You're a seasoned veteran. A short credit history, on the other hand, is like a recent college grad. You might be brilliant, but you're unproven. Lenders are taking a bigger gamble. This is why one of the worst things you can do is close an old credit card, especially one you've had for a long time, even if you don't use it. You might think you're being responsible by closing an unused account, but what you're actually doing is taking a pair of scissors to your financial resume and cutting off your earliest, most valuable work experience. That 10-year-old card with a 0 balance is an anchor of stability for your score. Keep it open. Use it once every 6 months for a small purchase like a coffee, and pay it off immediately just to keep it active. Don't erase your history. The fourth pillar at 10% is new credit. This category is all about how you've been shopping for credit recently. Every time you formally apply for a loan or a credit card, it results in a hard inquiry on your report. 1 or 2 inquiries here and there are totally normal. But if you suddenly apply for 5 credit cards and 2 personal loans in a single month, it sets off alarm bells. To a lender, this looks like desperation. It signals that you might be in financial trouble and are trying to get cash from anywhere you can. It's a major red flag. This is different from a soft inquiry, like when you check your own score or when a company sends you a pre-approved offer. Those don't affect your score at all. The takeaway here is to be strategic. When you're in the 6 to 12-month window before applying for a mortgage, stop applying for any other new credit. No new car loans, no new store cards, nothing. Protect your score from those small temporary dips caused by hard inquiries. Let it stabilize and mature. Finally, the last 10% of your score comes from your credit mix. This is the skills section of your resume. Lenders like to see that you can successfully manage different types of credit. There are two main categories: revolving credit, which is your credit cards, and installment loans, which are things like a mortgage, an auto loan, or a student loan where you pay a fixed amount every month. Having a healthy mix of both shows you're a financially well-rounded individual. It's like a baker who can make both perfect bread and delicate pastries. It demonstrates versatility and competence. Now, this doesn't mean you should go out and get a car loan you don't need just to improve your mix. This is the least influential factor, and it tends to build naturally over time. But it's important to understand that having only credit cards, or only an installment loan, won't maximize your score. The algorithm rewards diversity. So there you have it. The 5 pillars. 35% for paying on time, 30% for keeping balances low, 15% for having a long history, 10% for limiting new applications, and 10% for having a good mix. It's not a mystery. It's math. And now you have the formula. You can look at your own credit report and see exactly where you're winning and where you need to improve. You can see how every financial decision you make maps directly to one of these 5 categories. You're no longer flying blind. You have the blueprint. But knowing the blueprint and knowing how to build the house are two different things. People who know these rules still make catastrophic mistakes, especially in the months leading up to a mortgage application. There's one mistake in particular. It seems so smart, so responsible on the surface. People think they're doing the absolute right thing for their finances. But this one move can send your credit score into a nosedive right when you need it most, and it can get your mortgage application flat out denied, even if you were pre-approved. It's a silent killer of homeownership dreams, and we're going to expose it in the next part. So what is this mistake? What is this silent killer? It's something that feels completely harmless, even logical. It's the temptation to make a big purchase on credit between your mortgage pre-approval and your final closing day. I call it the new credit trap, and it has crushed more homeownership dreams than almost any other single mistake. Let me paint you a picture. Meet Alex and Jamie. They've done everything right. They saved for years, paid down their credit cards, and polished their credit scores until they shined. Alex has a 760. Jamie has a 780. They walk into a lender's office with confidence, and they get pre-approved for a $400,000 loan. They're ecstatic. The hunt is on. After a few weeks of searching, they find it. The perfect house. A little Cape Cod with a big backyard for their dog. They put in an offer, it's accepted, and they are officially under contract. Now begins the underwriting process, that 30 to 45-day period where the lender verifies every single detail of your financial life. Their loan officer tells them, "Everything looks great, just hang tight. Don't make any sudden moves, and we'll see you at the closing table." So Alex and Jamie start dreaming. They measure the living room. They pick out paint colors. And then they see it. A massive Memorial Day sale at their favorite furniture store. 0% financing for 24 months. No interest if paid in full. Buy now and we'll deliver the day after you move in. Seems like a sign from the universe. It's perfect. Why move into an empty house? They can get the beautiful sectional sofa they've always wanted, a new dining room set, a king-sized bed, all without paying a dime in interest for 2 years. Feels like a financially savvy move. They're not spending their cash reserves, which they need for closing costs and moving expenses. So they go to the store, pick out $10,000 worth of furniture, and apply for the store credit card to get the special financing deal. The application takes 90 seconds. They're instantly approved. They walk out of the store with a receipt and a huge sense of accomplishment. They've just furnished their new home without touching their savings. They feel like geniuses. They have no idea they just detonated a financial bomb under their mortgage application. Here's what happens next behind the scenes. The lender, as part of their final due diligence, does something called a credit refresh, or a soft pull, just a few days before the scheduled closing. They are not looking to see if your score went up or down a few points. They are looking for one thing: change. Specifically, new accounts or new inquiries. And suddenly, a red flag the size of Texas pops up on their screen. They see a brand new inquiry from Big Box Furniture Incorporated. And more terrifyingly, a new revolving account with a $10,000 balance. The underwriter's phone rings. The loan officer's heart sinks. He has to make the call. "Hi, Jamie. It's Mark from the mortgage company. We have a problem. The blood drains from Jamie's face. The lender explains that this new $10,000 debt has completely changed their financial picture. Remember that all-important debt-to-income ratio, or DTI. Let's say their new monthly payment for that furniture is $420. That single payment might have just pushed their DTI from a perfectly acceptable 41% to a disqualifying 44%. But it's even worse than just the math. To a risk-averse underwriter, this isn't just a new payment. It's a signal. It signals that the borrowers might be financially stretched. It signals that they are taking on new debt right before taking on the biggest debt of their lives. It screams impulsiveness and risk. The entire foundation of trust that the loan was built on has just cracked. The lender gives them two options. Option 1. The loan is denied. They lose the house. They lose their earnest money deposit, which could be $5,000 or $10,000. They're back to square one, with a fresh credit inquiry and a new high-balance credit card dragging their scores down. Option 2. The loan is put on hold. They can only close if they pay off the $10,000 furniture debt in full. But they can't. They used the financing specifically because they needed their cash for closing. They are trapped. This story plays out in thousands of variations across the country every single month. It's not just furniture. The biggest culprit is a new car. People think, I'm getting a new house with a 2-car garage. I should get a new car to go in it. They go finance a $40,000 SUV, adding a $700 monthly payment to their DTI. And their mortgage evaporates overnight. It's a catastrophe. So how do you avoid this nightmare? You need to implement what I call a credit lockdown. From the moment you decide you are serious about buying a home, not from pre-approval from the very beginning, until the moment the keys to your new house are physically in your hand and the closing documents are signed, your financial life must enter a state of suspended animation. You become a financial ghost. You change nothing. Here are the absolute unbreakable rules of the credit lockdown. Rule number 1. You will not apply for any new credit of any kind. I don't care if it's a credit card offering 1 million airline miles, a personal loan, a new car lease, or a financing deal on a lawnmower. The answer is no. If you need to make a large purchase, save up and use your debit card or cash, but only after talking to your loan officer about how it might affect your cash to close. Rule number 2. You will not co-sign for anyone. Your friend, your brother, your child, it doesn't matter. When you co-sign, that debt legally becomes your debt in the eyes of the lender. It will appear on your credit report and will be factored into your DTI, even if you never make a single payment. Just say no. You can help them after you close on your house. Rule number 3. You will not close any existing credit accounts. This is a counterintuitive one. You might think, I'll close this old credit card I never used to clean up my report. Don't. Closing an account can actually hurt your score by reducing your overall available credit, which increases your credit utilization ratio. It also shortens your average age of accounts. Just leave everything as it is. Rule number 4. You will not make any large, unexplainable deposits into your bank account. Lenders have to source every penny you're using for the down payment and closing costs to comply with federal anti-money laundering laws. If your uncle gives you $5,000 in cash as a gift, you can't just deposit it. It has to be properly documented with a gift letter. Any cash deposit that can't be sourced will be thrown out by the underwriter, potentially leaving you short on funds to close. And finally, rule number 5, which is more of a guideline, try not to change jobs. While sometimes unavoidable, changing jobs, especially from a salaried W-2 position to a commission-based or self-employed role, can throw a massive wrench in the works. Lenders prize stability above all else. A new job, even with a higher salary, introduces uncertainty. If you absolutely must change jobs, talk to your loan officer before you even accept the offer. Your only financial mission during this period is to be as boring as humanly possible. Pay every single bill on time every time. Keep your credit card balances as low as you can, preferably at 0. Let your paychecks deposit as usual. That's it. You are a rock. You are unchanging. You are a lender's dream. By following these rules, you eliminate the single greatest threat that stands between you and the closing table. You take control and ensure that a last-minute mistake doesn't turn your dream home into a financial cautionary tale. Now you've protected your credit score, you've avoided the new credit trap, and you're ready for the final underwriting inspection. But your credit score, as critical as it is only one piece of a much larger puzzle. The lender is about to perform a full financial autopsy on your application, And there are 3 other numbers completely separate from your credit score that can get your loan approved with flying colors or denied on the spot, even if you have a perfect 850 score. We need to talk about them. The first of these critical numbers is arguably more important than your credit score itself. It's called your debt-to-income ratio, or DTI. Think of your gross monthly income, that's your salary before taxes, as a big, delicious pie. Every month you have to cut out slices of that pie to pay for things you owe: your car payment, your student loans, the minimum payments on your credit cards. What lenders want to know is, after you add a new big slice for a mortgage payment, how much of your pie is already spoken for. Your DTI is that percentage. It's a simple formula. Your total monthly debt payments divided by your gross monthly income. Now, there are actually 2 types of DTI, and it's crucial to know the difference. The first is the front-end ratio. This only looks at your proposed housing costs, your future mortgage principal, interest, taxes, and insurance, or PITI, as it's known in the industry. The second, and the one lenders obsess over, is the back-end ratio. This is the big one. It includes your new mortgage payment plus all your other monthly debts that show up on your credit report. Car loans, student loans, personal loans, credit card minimums, child support, it all goes into the calculation. Let's make this real. Meet Sarah. Sarah makes $7,000 a month before taxes. That's her gross monthly income. Her monthly debts are a $400 car payment, a $300 student loan payment, and about $100 in credit card minimums. So her total existing debt is $800 a month. Now she's found a house she loves, and the estimated monthly mortgage payment, including taxes and insurance, is going to be $2,200. To find her back-end DTI, the lender adds her existing debts, $800, to her new potential mortgage, $2,200. That's a total of $3,000 in monthly obligations. They then divide that $3,000 by her gross monthly income of $7,000. The result? About 42.8%. So Sarah's DTI is 43%. Is that good? Well, this is where the magic numbers come in. For decades, the gold standard was the 28 of 36 rule. It meant your housing costs shouldn't be more than 28% of your income, and your total debt shouldn't be more than 36%. But times have changed. Today, for a conventional loan, the most common type of mortgage, lenders generally want to see a DTI of 43% or less. Sarah at 43% is right on the edge. Some lenders might cap it at 45% or even 50% if you have a high credit score and a large down payment, but 43% is a major benchmark. If you go over that, your application starts flashing red. For government-backed loans, there's more wiggle room. An FHA loan might allow a DTI up to 47% or even 50% without much fuss. I've even seen some FHA loans get approved with a DTI as high as 56% if the borrower has compensating factors, like a perfect credit score or a ton of cash in the bank. But make no mistake, a high DTI is the #1 reason seemingly qualified people get denied for a mortgage. It tells the lender you're stretched too thin, that one unexpected car repair or medical bill could push you over the edge and into foreclosure. Your 800 credit score won't matter if the math shows you can't afford the payment. So that's the first gatekeeper. The second critical number lenders scrutinize is your loan-to-value ratio, or LTV. If DTI is about your monthly cash flow, LTV is about your commitment. It's about how much skin you have in the game. The calculation is simple. It's the loan amount divided by the home's appraised value. Let's say you want to buy a $400,000 house, and you're putting down $40,000. Your loan amount would be $360,000. So you divide $360,000 by $400,000, which gives you 0.90, or a 90% LTV. Why does this matter so much? Because it represents the lender's risk. An 80% LTV, which means you put 20% down, is the holy grail. At 80% LTV, you have a significant equity cushion from day one. If you stop making payments and the bank has to foreclose, they're confident they can sell the house and get their money back, even if home prices have dipped a little. But if you have a 97% LTV, meaning you only put 3% down, the lender is terrified. If prices drop by just 5%, you're already underwater, meaning you owe more than the house is worth. This makes it much more likely for a borrower to simply walk away if they hit a rough patch. To protect themselves from this high risk, lenders will force you to pay for their insurance policy. It's called private mortgage insurance, or PMI. PMI is one of the most hated expenses in homeownership because it's a monthly fee that does absolutely nothing for you. It only protects the lender. and add hundreds of dollars to your monthly payment, and on a conventional loan, you typically have to pay it until your LTV drops to 80%. So, a lower LTV not only makes you a stronger candidate, it can save you a fortune by avoiding PMI. While many programs exist that allow for low down payments, FHA loans require just 3.5% down, and some conventional loans allow for 3%, you need to understand that a higher LTV means you will pay a price, either through PMI or a higher interest rate. Okay, so your DTI is low, your LTV is solid. You're done, right? Not yet. There's a third number, a safety net that lenders demand to see. It's your cash reserves. Cash reserves are the liquid, accessible funds you will have left over after you've paid your down payment and all your closing costs. This is your what-if fund. What if the furnace dies a month after you move in? What if you lose your job? Lenders need to know you won't immediately default on your brand new mortgage at the first sign of trouble. They measure your reserves in terms of months. Specifically, how many months of your full mortgage payment, that pity we talked about, could you cover with the money you have left in the bank? For a standard owner-occupied home, most lenders want to see at least 2 months of pity in reserves. So if your total mortgage payment is $2,500 a month, they'll want to see proof that you have at least $5,000 left in a checking, savings, or investment account after the deal is done. And that's the minimum. If you're self-employed, have a slightly higher DTI, or are buying an investment property, the requirements shoot up. For a rental property, it's common for lenders to require 6 months of pity in reserves for each property you own. This proves you have the financial stability to weather vacancies or major repairs without missing a payment. What counts as reserves? Things like checking and savings accounts are counted at 100%. Stocks, bonds, and mutual funds usually count too. Even your 401k or IRA can often be used to meet the requirement, though the lender might only count 60 or 70% of the vested balance, since you'd have to pay penalties and taxes to access it. These three numbers, debt to income, loan to value, and cash reserves, form a financial triangle that supports your entire application. Your credit score is the foundation, but without this triangle, the whole structure collapses. You can have a perfect 850 score, but if your DTI is 60%, or you have $0 left after closing, you will not get the loan. They work together to paint a complete picture of you as a borrower. Do you manage your debt well? Do you have a real stake in the property? And can you survive a financial storm? Now you know the 4 pillars of mortgage approval: credit score, DTI, LTV, and cash reserves. But knowing them is one thing. Building a bulletproof application that gets you the best interest rate and saves you tens of thousands of dollars over the life of your loan is another game entirely. In the final part, we're going to lay out the ultimate 7-step pre-approval checklist that top loan officers wish every single buyer would follow before walking through their door. This is that checklist. This is the blueprint for turning a stressful, uncertain process into a smooth, confident, and successful home purchase. Follow these 7 steps in order, and you won't just be ready for a lender, you'll be the exact type of borrower they are competing to work with. Step 1. Conduct a full-spectrum financial audit on yourself. Most people hear this and think, oh, I checked my score on a free app. That's not what we're talking about. That's like a doctor diagnosing you from across the room. We need an MRI. You need to go to annualcreditreport.com, the official, government-mandated site, and pull your full credit reports from all 3 bureaus: Experian, Equifax, and TransUnion. This is your first look at what the lender will see. Print them out. Get a highlighter. Go through every single line item. Is that old medical bill that you paid off still showing as a collection? Is there a credit card listed that you've never even heard of? According to the FDC, 1 in 5 people have an error on at least one of their reports. Finding and disputing these errors before a lender sees them can be the single biggest jump to your score you can make. This isn't just about the score. It's about the story. Every line on that report tells a lender part of your financial story. You need to become the editor of that story, and make sure it's telling the absolute truth before you submit it for review. Step 2. Assemble your 2-year time capsule. Lenders don't just care about who you are today. They care about who you've been. They want to see a stable, predictable pattern of income. The single best way to prove this is to have your documents ready before they even ask. This means you need to gather the last 2 years of your federal tax returns, every single page. You need your last 2 years of W-2s from all employers. And you need, at a minimum, your last 2 months of pay stubs. Digitize them. Create a folder on your computer labeled Mortgage Docs. Why? Because when a loan officer asks for these, and you send them over in 10 minutes, perfectly organized, you send a powerful unspoken message. I am prepared. I am serious. I am not a risk. This simple act of preparation immediately separates you from the 90% of applicants who have to scramble, who send blurry phone pictures of crumpled papers, and who look disorganized and, by extension, financially chaotic. You are building a case for your own reliability, and this is Exhibit A. Step 3. Master your debt-to-income ratio, or DTI. This is the number that keeps loan officers up at night. It's the ultimate indicator of your financial breathing room. In simple terms, it's all your monthly debt payments, student loans, car payments, credit card minimums, divided by your gross monthly income. Lenders have hard limits on this, often around 43% for conventional loans. But here's the secret. Don't just calculate your DTI, actively manage it. Look at your debts. Do you have a small personal loan with a $100 monthly payment? Or a store credit card with a $50 minimum payment? If you have the cash, paying off that one small debt completely doesn't just lower your DTI, it eliminates an entire payment from the calculation, which can have a massive impact. Think of it like a hot air balloon. Your income is the flame lifting you up. Every debt payment is a sandbag weighing you down. Cutting even one small sandbag loose can give you significantly more lift, allowing you to qualify for a better loan or a higher purchase price. In the 3 to 6 months before you apply, your mission is to cut sandbags. Step 4. Document every penny of your cash to close. This is one of the biggest hurdles for first-time buyers. They save up for the down payment, but they forget about the rest. Your cash to close is your down payment plus your closing costs, which can be 2 to 5% of the home's price, plus your prepaids and escrows, which is money for your first year of homeowners insurance and property taxes. You need to have this money, and you need to be able to prove where it came from. Lenders need to see that this money has been seasoned, meaning it's been sitting in your bank account for at least 2 months. A large, sudden deposit of $10,000 in cash looks like an undocumented loan from a relative, which counts as a new debt and could get your entire application denied. If your parents are gifting you money for the down payment, that's great, but it requires a formal gift letter and a paper trail. So start now. Open a dedicated savings account. Put all your house money there. Let it sit. Get the gift letter signed. When the lender asks for your bank statements, they'll see a clean, clear, and documented source of funds that makes their underwriters breathe a sigh of relief. Step 5. Initiate the employment lockdown. From the moment you decide you're serious about buying a home until the day you have the keys in your hand, you must become the most boring, stable employee on the planet. Do not change jobs. Do not switch from a salaried W-2 position to a 1099 independent contractor. Do not quit your job to start your dream business. Do not even accept a promotion if it changes your pay structure from salary to commission. Why? Because lenders underwrite the person who applied, not the person you're about to become. A job change, even a good one, creates new paperwork, new verification requirements, and introduces uncertainty. The underwriter has to verify your new income, and if you don't have a history of it, they might not be able to use it. I've seen it happen. Someone takes a better job mid-process, and their loan falls apart a week before closing because their new income stream isn't considered stable yet. Think of it as financial hibernation. For the next few months, your career is stable, predictable, and unchanging. Celebrate the new job after you've moved in. Step 6. The Prime Directive. Do not apply for new credit. This is the cardinal sin of the mortgage process. Your credit score is a snapshot in time. When the lender pre-approves you, they are approving that specific snapshot. Any change can force them to reevaluate everything. This means you do not go to the furniture store and apply for their no interest for 24 months deal to furnish your new house. You do not go buy a new car because you'll finally have a garage to put it in. You do not open a new credit card to get the sign-up bonus for travel points. You do not co-sign a loan for your cousin. Every time you apply for new credit, 2 things happen. You get a hard inquiry, which can ding your score, and if you're approved, you increase your total debt load, which throws your DTI ratio out of whack. Lenders do what's called a soft pull on your credit again, right before closing. If they see a new car loan that wasn't there before, it can be grounds for immediate denial. Your credit is frozen in amber. Don't touch it. And finally, step 7. Run the lender gauntlet. Do not just go to the first bank you see, or the one your real estate agent recommends. You are about to enter into the largest financial partnership of your life. You need to interview your potential partners. Your mission is to get pre-approved by at least 3 different types of lenders: a big national bank, a local credit union, and a mortgage broker. Why the variety? Because they all have different programs, different overhead costs, and different appetites for risk. The big bank might have great jumbo loans. The credit union might have an amazing first-time buyer program with lower fees. And the mortgage broker can shop your application to dozens of wholesale lenders, finding a niche loan you'd never find on your own. When you talk to them, ask these questions. What are your total lender fees, not including third-party costs? What is your average turnaround time from application to closing? Can you provide me with a full loan estimate so I can compare offers apples to apples? Getting multiple offers doesn't just give you options, it gives you leverage. You can take the best offer and see if another lender is willing to beat it. This one step can save you thousands in closing costs and tens of thousands in interest over the life of the loan. This checklist isn't just a series of hoops to jump through. It's a strategy. It's about shifting the power dynamic. When you walk into a lender's office with your documents organized, your credit cleaned up, your down payment seasoned, and your financial life stabilized, you are no longer just asking for a loan. You are presenting yourself as a low-risk, high-value investment. You become the client they want to win. The credit score got you in the door, but this preparation is what allows you to command the best terms, the lowest rate, and the smoothest path to homeownership. You've done the work. You've built the foundation. Now you're ready to build your future on top of it.